Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. If you follow the inflation report every month, you know that housing has been a particularly sticky sector that shows little sign of easing in inflation. Well, we may see the beginning of a tide change. Today, we will look at how home prices around the US are starting to react to higher interest rates in 2023. From shifting home prices to inventory surges, there's a lot to unpack. But before we dive in, make sure to hit that like button and subscribe to our channel. Your support keeps us motivated to bring you valuable content. Now, let's explore the changes taking place across the country. In the United States, we're witnessing significant transformations in both the economy and the housing market. One noticeable trend is the drop in asking prices by home sellers in various regions. But it's not limited to just reductions in home prices. We are surprised to see that there is actually an increase in the housing inventory, which is the number of homes available for sale. With the higher interest rate environment we are currently in, housing inventory which has reached a record-breaking high for the year 2023. Additionally, we're witnessing homeowners making unexpected relocations and other intriguing developments, all attributed to the impact of higher interest rates. Talking about interest rates, we are seeing rates across the board have been going up steadily. However, it's important to understand that bond markets are very dynamic. Many large investment funds use automated trading algorithms. These algorithms are designed to automatically make buying and selling decisions, particularly after weeks of continuous selling that have left bonds oversold and the market is feeling overwhelmed. Right now, the situation is similar to what we saw last week, and we're getting closer to a deadline for the government's debt limit. If a deal is reached in November, it could lead to the government borrowing trillions more, which might result in more treasury auctions. Such actions could lead to potentially higher interest rates, as we saw from last week's auction results that there was very weak demand for treasury at the moment. However, a lack of a deal could also rattle investors' confidence and result in a sell-off. We also have a FOMC meeting in November. Although the market expects the Fed to keep interest rates unchanged in this meeting, an unexpected change in the Federal Reserve's policies, or a shift in December's outlook could lead to unpredictable directions. The interest rates are currently at their highest levels in over 15 years, with mortgage rates are sitting at 7.66%. These rate hikes, coupled with lenders tightening their lending standards, are making it increasingly challenging for individuals to qualify for various types of loans. Meanwhile, auto loan rates are approaching 8%. This means that financing a car has become twice as expensive compared to a year ago. The effects of these changes are beginning to manifest in various ways, notably in the form of auto loan delinquencies. Serious delinquencies are a growing concern. Goldman Sachs, in a recent note addressing this issue, emphasizes the importance of focusing on delinquencies rather than just overall debt. The article titled Credit Card Debt versus Delinquencies. They wrote this: "In recent months we have received several client questions about credit card debt, with concerns about the fact that it exceeded $1.0 trillion for the first time ever in 2Q 2023. In our view, this development is neither surprising nor particularly worrying. It largely reflects inflation and economic growth." However, new 30-plus day and 90-plus day delinquencies have been rising sharply, and the former was above pre-COVID levels in 2Q. This suggests that total delinquencies could trend up in coming quarters. The 3Q data will be released in early November. They wrote this bottom line: when it comes to credit cards, investors should focus on delinquencies, not debt. They predict that total delinquencies could continue trending upward in the coming quarters. The rise in new delinquencies raises a red flag, signaling potential challenges in the financial landscape. When the Federal Reserve makes changes to its monetary policy, it takes time for these changes to affect the economy. This effect varies among individuals, depending on their financial situation. Think of it like a complex network of pipes that connect everyone and every business in the country. When the Fed makes a change, it's like slowly adjusting a dial that influences these financial pipes. It takes a while for the effects to reach different parts of the system, and this delay can lead to different outcomes. Over time, these effects can build up, potentially leading to what's called a hard landing scenario or even a recession. Historically, the housing market is often the first to reflect these interest rate-sensitive shifts. Commercial real estate defaults are already surging, and the housing market is currently experiencing its slowest pace ever. Despite this, home prices remain near all-time highs due to a shortage of available inventory. The number of homes on the market has been insufficient to significantly impact prices. However, a glimmer of change is emerging. Recent data reveals a notable uptick in housing inventory over the past 2 months. The lack of inventory has been the primary factor preventing a housing market crash or significant correction. Notably, a surge in new listings in the last 2 months can't be attributed solely to seasonality. Major publications, including Zillow, have acknowledged this trend, highlighting the increasing number of price reductions. In their recent article, they mentioned the seasonal cooldown for the housing market is shaping up to be extra chilly this fall, swinging negotiating power toward buyers. They also pointed out the new listings drought has modestly improved. Since July 2022, the flow of new listings trended almost continuously toward ever deeper seasonal lows. But this August saw an unusual month-over-month increase in new listings, which slashed the year-over-year deficit roughly in half from its July gap. It's too soon to declare the worst of the new listings drought behind us, but it is an extra point for supply in the supply and demand equation that determines the push-pull dynamics of the market. You know, they say real estate is all about location, location, and location. When it comes to home prices, different areas show different reactions, but the overall trend is that home inventory is starting to build up from record low levels. Many areas are seeing price drops and increased price cuts, giving more negotiation power to buyers. Some places have experienced a decline in home values, making homeownership somewhat more affordable, while others are facing stagnant prices due to low inventory. Overall, the housing market is undergoing shifts that vary by location. We will continue to monitor development in this area. If the prices do start to fall on a national scale, that is a good thing for the Fed in the fight against inflation. And that concludes today's video, where we've explored the evolving landscape of the U.S. housing market in 2023. If you found this information insightful, don't forget to give us a thumbs up. Your feedback is invaluable to us, and it keeps us motivated to continue delivering in-depth analysis like this. Thank you for joining us today at InvestGrowthWisdom, where knowledge is your key to success in the ever-changing world of real estate. Stay tuned for more exciting insights, and until next time, happy investing!